Imagine you're the finance minister of India. You have big dreams: new highways, modern railways, better hospitals, more schools, stronger defense. But then you open the government's bank account and there is a problem. The money collected through taxes is not enough. The government's expenses are greater than its income. Now what? Can the government borrow money from a friend? Not exactly. Can it take a bank loan like ordinary people? Not practical. The government needs thousands of crores. So it uses a special method. It issues something called Government Securities or GSECs. Think of GSEC as an official IOU. The government says, lend me money today, I promise to repay you later with interest. People trust this promise because it comes from the government of India itself. And that's why GSECs are considered among the safest investments in the country. Now let's see how the borrowing actually happens. Imagine the government needs 10,000 crores. It asks the Reserve Bank of India to conduct an auction. Banks, insurance companies, mutual funds, pension funds, and other investors participate. They bid for these securities. The highest acceptable bids win. The investors give money to the government. The government gives them GSECs. Simple. Money moves to the government, the security moves to the investor. Everyone gets what they want. The government gets funds. Investors get a safe investment that pays interest. Now, here is the interesting part. There are different types of government securities. Some are Treasury bills, T bills. These are short term borrowings, usually for less than 1 year. Others are dated securities which may mature after 5, 10, 20, or even 40 years. Think of T bills as short term borrowing from a friend. Think of long term G6 as taking a home loan that lasts decades. Every year, the government pays interest to investors. The interest is called the coupon payment. When the security matures, the government returns the original amount as promised. But the story doesn't end there. After purchasing G6, investors can sell them to others in the secondary market. This creates a large market where government debt is traded every day. In fact, the interest rate on G6 becomes a benchmark for the entire economy. Banks, companies, and financial institutions often use G6 yields as a reference point while settling borrowing costs. This is why economists closely watch the yield on a 10-year government security. It acts like the pulse of India's financial system. So, what are government securities? They are debt instruments issued by the government to borrow money from investors. And how does the government borrow through them? By issuing these securities through RBI managed auctions and promising repayment with interest. In short, whenever you see a new highway, railway line, airport, or public project, remember behind many of them stands a simple piece of paper, a promise made by the government, a government security.